be covering the first topic of today.
Thanks. Okay, thank you everyone for joining us here today. So I'm just going to explain how the Singapore market is surfing through this stagflation wave. That's me but in the picture, by the way, you can't recognize. Firstly, if you want to experience stagflation now, the best place to be is probably in the UK now, because like the Bank of England has mentioned, they are projected to enter a recession, and also inflation will remain elevated. So it's like the worst of both worlds. So when we say stagflation, it's basically a sharp slowdown and also with inflationary conditions. And for those who have economists hat on the reason why you suffer, why is there inflation even though demand is weak, it's mainly because there's a supply shock to the economy, and that's why you get this so-called stagflationary. But we just want to explain to you why Singapore will be able to surf on this stagflation way. This is our disclaimer. I know nobody reads, but let me just go through. Mainly, these are all our own personal views. We take a lot of market data which we can't, public data which we can't verify, and please seek advice from your financial advisor. So on the first slide, as usual, we will just run through what's the performance of the STI. This is in US dollar. I mean, in Sing dollar, I think STI is probably up about 3%, excluding dividends. So you can see that from the chart, STI has been a bit range bound, but in the current environment, year to date means this year, it has probably outperformed many asset classes, except of course commodities. So anyone who has bought commodity ETFs the last 2 years, congrats. You may not actually need to be in this event. Some of the worst performers has been, of course, NASDAQ and so forth. Even bonds has performed badly. So bonds typically has been the place to hide out, but I guess not so right now when you are faced with inflation worries. Gold, supposed to be an inflation hedge, also doesn't work. Of course, anything that even looks like a bond, like REITs, are also suffering, not only last year, but even this year. But again, these are excluding dividends, so you may not lose that much if you have REITs, since they're paying out some dividends for you. MSCI, Asia Pac, Japan is mainly, a lot of Chinese tax names are there, so that's why you can see the weakness. Just to narrow down on what has performed well on the STI, since if you're buying an STI ETF, I guess you need to know the flavor of all the stocks. So STI, there are 30 stocks in there. This year, you can see banks are moving sideways, apart from OCBC. The best performance on STI this year has been some of the conglomerates, namely Sembcorp Industries, Keppel Corp. These are mainly due to restructuring reasons. And of course, a bit better spark spreads. The Jardine was because of Astra performing well. The worst performers, again, anything that's bond-like, looks like a bond, smells like a bond, is going to be performing badly, and that is mainly the REITs. They have been the worst performers. Property also performed. So property is really hot market right now, but again, CDL, CLL, and also UL. Property is probably the second largest component of the STI. Okay, so enough of performance. So we just want to explain to you what are the economic conditions that we are in now, why we call it a stagflationary environment. So, of course, there are many economists that predict, but the best predictor has so far been the yield curve. We call it the best economist, since hiring one additional economist is probably one extra headcount too many. So instead, we use the yield curve. So the yield curve has been a really good predictor. You can see in beige, that's when recession happens. And whenever it inverts, be it 6 or 18 months earlier, that typically comes with it a recession. Of course, technically, second quarter, the US is already on paper in recession. But regardless, even if there's no recession, what it just indicates is that the next 6 to 18 months expect economic slowdown, especially in the US. And of course, this will also transpire across into Europe. So that's just to reinforce that we're having a growth slowdown. Then, of course, the new challenge now, which we never had, the last decade, inflation was below 3. These are US inflation. not Singapore, which is also very high. But this is namely on the US inflation. So if you look, this is as far as you can go in terms of data points, unless you pick it up from some books. The last time we had such a severe inflation was in the 1970s. Somewhat similar, you got also the Yom Kippur War, energy shock 1, then energy shock 2, oil crisis. You have guns and butter. Basically, the US government was spending more on the Vietnam War and all that. So these were really exogenous things that will cause a spike. We face a similar situation. I think we all know there's a conflict in Ukraine, and of course, energy prices are up. But I mean, we don't think it would be a replica, because to replicate the kind of inflation that you have in the 1970s, which also included like 4 recessions. So we're not in such a dire condition, but again, inflation is high and it's a new challenge for the Fed. So just to take a step back, right now we're having slow economic growth, at the same time rising inflation. And as a result of that, we are also having rising interest rates. So the blue line that you see is interest rates, and the red line is the US inflation. So you can expect there's another 3 more Fed meetings coming up. So you can expect a minimum of at least 100 basis points rise, which is a fancy word for just saying it's a 1 percentage point more increase in interest rates to be expected. And even a 1 basis point increase in interest rates is also quite conservative. So this is probably the most dovish Fed, if you look at historically, regardless how much they say they want to raise interest rates, the blue line right now is so far below the inflation rate. So what it means is that never before has the Fed been so loose. Of course, there are certain periods, but to be so far away from inflation, this is the one still, even though raising 100 basis points, they are still far lower than inflation rate right now. But you should expect interest rates to continue to climb at least until the end of this year. My next slide is, why is this important? Why it will benefit Singapore is because if you see the red line, which is again the US interest rates, it runs very close to Singapore interest rates. I mean, you can calculate 90, 80%, but it's just very high. It's like almost 90% correlation. So whenever US rates increase, you can generally assume, of course it can be SOR rates, but that's more exchange rate dependent, but you can assume that interest rates in Singapore will also similarly rise roughly around 100 basis points. So this is very critical, because this will mean that rising interest rates will also benefit the banks. And because in Singapore, 40% of the index come from the banks, and that's why in an inflationary environment, it leads to higher interest rates, leads to better earnings for banks. And banks benefit from 2 ways, because most of the banks, they got a lot of extra deposits. And you can just earn extra couple $100 million without doing anything virtually. You don't need even extra staff to kind of park money to park money in your excess deposits. And of course, your loans also will be priced faster, whereas a lot of our Singapore banks have high CASA, which, as we all know, pays nothing. So as a result of this, they can raise loan price higher, but at the same time, the cost of deposits is low. So that's why these are the 2 ways where the banks benefit, again, without virtually doing anything apart from sending us letters that our mortgage loans are higher right now. If you move on just to Singapore economy, so just to get back again, we benefit, interest rates are high, and also Singapore is also having, our economic conditions are also performing very well. Firstly, if you look at the foreign direct investments, we are close to record levels. Of course, the authorities don't whisper to my ear who are the foreign companies coming in, but just to give you a flavor, if you look through JCC reports and see who's buying land in Singapore, or at least preparing to build something, these are all for your reference. It can be Google, Hyundai, Motor, a lot of wafer fabs also coming to Singapore. Oh, that time's now. Okay, the other thing that's happening in Singapore is also there's revenge spending, revenge eating, revenge buying watch, revenge buying fashion, because retail sales now in Singapore is running about 15%, which is maybe 10, 15 times faster than pre-pandemic. Pre-pandemic retail sales in Singapore was probably 1%. So, so the economic conditions in Singapore is especially vibrant. And the other thing that is a back burner is also tourism. So pre-pandemic, tourism is almost 5 percentage points of the economy, which is huge, because Singapore is not like, we're not like a 5, 6, 7% growth economy. So when tourists don't come in, we lose out 5 percentage points. But now that we reopen, there's this tailwind supporting the economy as more and more, as the borders reopen and more tourists come in, which may not be that for the region, not only for us, but across the region, you get this tailwind. So that's why we won't face similar kind of recessionary conditions like the US. Just last three slides. Just last three slides. So probably this is the more important slide. So if you buy into a STI ETF, I guess you want to know what's inside. So to give you a sense, almost every sector, if you break it down by sector, is enjoying a tailwind. So for finance, so almost 50% of the index is benefiting from higher interest rates, including even the SGX. Okay, the problem right now we have on STI is probably REITs. So maybe you can buy STI X REITs, but I mean, you can't do that. But the one that's dragging down is, of course, REITs. Property is, of course, doing well in Singapore. The only thing we worry is maybe there could be more cooling measures. Jardine is doing well because they're mainly Southeast Asia, so that is all benefiting. Singtel also doing because of roaming revenue. So virtually every sector is doing well. Transport, of course, because of the reopening. Conglomerates, best performers, because after so many years, they decided to dispose of some things that they don't need. Consumer is also doing well because of the whole reopening, like Thai Bev, because last year in Thailand it was totally closed, so now it's opening back up again. So year on year, everything there. Wilmar is a bit more neutral and nuanced because they benefit from higher commodity price, but also there are certain parts that may not benefit, like edible oil. But in general, the message here is that virtually 80–90% of probably 85% of the index has a tailwind as we ride through this stagflationary wave. Last two slides for me will be just the valuations. So valuations are attractive on a PE basis. So you can see from here is at the lower bound. I mean, standard deviation is just a fancy term, but actually basically the upper bound or lower bound compared to historical averages. But you can see that it's trading at the lower quartile of compared to history. My last slide. But of course, the only thing is when you measure against inflation, that's when you measure against interest rates. So the dividend yield for STI is usually around 4%. But with interest rates rising, of course, buying STI for dividend yield won't be as attractive because bonds have already climbed up, right? So the thing is that if interest rates rise, then of course, if I'm buying any stock with dividend yield, you better pay me more since I can get it. I can buy a bond, I need to buy equity right now. That is about fair. So generally, PE is low, but just that on a dividend basis, in a nutshell, the corporates maybe need to raise the dividend game a bit to make it more attractive for someone who wants to buy equities just for the dividend yield. Okay, I think I surprisingly met the timeline, but in terms of the conclusion, our message here is that we are facing a stagflationary wave, slower growth, rising inflation, but Singapore sectors can benefit because ironically, inflation is actually good for the STI because of the higher interest rates. And of course, we get this economic tailwind because of the reopening. These are the sectors we favor. We won't go through them because these are more stock selections. And this is our STI target. So 12 months time, don't come and ask me why we didn't hit this target, but just for your reference. Okay, I think that's it for me. Thanks. Okay, thank you, everyone.
Should be okay. Yeah. Hello. Can you all hear me? It's good. From the back. Hi. My name is Teck Leng. So I'm a fund manager over at Phillip Capital Management. So among the products that we run, both active funds and ETFs. So our ETF division we started in 2016. So this is one of the ETFs that we are introducing to you, which is focused on Singapore dividend stocks. This is called the Phillip Sing Income ETF. Okay. The disclaimer would largely be the same in essence as Paul's. Okay, I won't go through in detail. Today I'm going to be covering three main things relating to this product. Firstly, I'll just set the backdrop for the first point about the importance of dividends. Secondly, the dividend trap, right? And then finally, I'll introduce you to the Phillip Sing Income ETF. Now, dividends, as you know, they are typically funded from the company reserves, and they tend to grow in step with profits. And that means it tends to be reflective of the company fundamentals, and it tends to be more stable, right? There is consistent evidence that dividend yields, dividend-paying stocks, they tend to be outperforming non-dividend-paying stocks during bear market periods, and that's logical because they are supported by cash flow, right? So the nature of their business is one reason. Second reason is also that the kind of people or investors who buy into dividend stocks, they would be more focused on the cash flow, the dividends. They are more, I guess, long-term focused, right? So that is some of the reasons why this is so. And thirdly, it's important because the willingness of companies to give dividends is a signal, it sends a signal in itself that they are shareholder oriented, and that's important, right? It limits the unproductive use of assets. So, that is the experience across the region, it's not just in Singapore, right? Of course, there are also other views that, if the profits can be better deployed back into the business, then it should, if the return on equity is high, right? But generally the experience is that the dividends is a strong signal of the shareholder orientation, right? And if you look at the track record of total returns over the past 10 years from 2011 to 2021, this is for the major markets, the major developed markets. So the blue one is basically the capital gains over the last 10 years. And then the orange one is the dividend return. All these are reduced to Sing dollar terms. So you can see that whether it's Australia, Singapore, Hong Kong, or Europe, right? The only exception is the US. But in these other major developed markets, dividends actually accounts for a majority of the returns over the longer term, right? So it makes sense to therefore, consider dividends within your investments framework, for example. Another reason why, this is a reason why Singapore stocks are attractive, right? It is a long-term currency, right? And that's important, I guess, for a foreign investor, a foreign dividend investor, right? He invests into Singapore. Why? Because firstly, the dividend yield is interesting, and of course, the dividend, Singapore is well known as a dividend market. Secondly, the Sing dollar itself is stable or even growing, appreciating over the longer term. This is showing from the period from 1990 until 2022, right? Actually, the Sing dollar has appreciated on average about 1% per year over the last 22 years, right? 30 years actually, yeah. So that is from a foreign investor perspective, actually the Sing dollar itself is attractive, right? So this is laying the background for dividend investing. Now, does that mean that you should go for the stocks that pay the highest dividend yield, for example, right? So here I will introduce you to the dividend trap. What is the dividend trap? So basically, it is saying that it is cautioning against such an approach. If you prioritize equity income by focusing on high dividend yields, for example, and there's the efficient market, there is often a reason why certain stocks are cheap and therefore the dividend yield is high, right? It's priced into the stock. Certain prospects may not be that good, and the market is actually acknowledging that, right? Maybe of low quality. That's why the dividend yield is high, and that's the dividend trap. Some examples, right? 2008 to 09, US financials, they were really cheap in terms of dividend yield, right? Because they'd gone down so much, therefore the dividend yield was as high as 20%, for example, 30%. That is a classic dividend trap, right? And you were looking back, and therefore it looks like the dividend is a lot compared to their current price. But the price had gone down for a key reason. Another example, Singapore energy and material stocks in 2014 to 15. right? And that was, for example, some of the oil and gas vessel charterers, right? Because they're offering very attractive dividend yields. Again, that is something to avoid, right? Rather than go into. So the corollary is this, that high dividend stocks or companies may be risky because either the big business is weakening, or in relation to that, there may be some financial problems. Maybe currently, I guess you can look at the China property companies in the current context, for example, right? I'm sure the China property companies listed in Hong Kong Exchange may have very high dividend yields if you compare their trailing 12-month dividend payouts versus their current price. But that's another classic dividend trap, right? Because they're in financial distress. You need a combination, therefore, of strong company fundamentals in addition to dividend yield in selecting the stocks that you should buy for your dividend or income portfolio. And this lays the backdrop for our Xiang Income ETF, because we set up with Morningstar, which is our index provider for the ETF, to solve the above problem of the dividend trap. Right? And we came out with this product, which launched in 2018 October. Right? It's a Phillip Xiang Income ETF listed on the exchange, SGX. What this does, it offers quick and easy access to a basket of 30 high-quality Singapore-listed stocks. The benchmark, so ETF, they always track a certain benchmark, right? In this case, we actually worked out with Morningstar to craft this Morningstar Singapore Yield Focus Index. That's the ETF, so-called the ETF benchmark index. Some key characteristics of this is limits individual stock weight to at most 10%. So it ensures diversification. It pays out semi-annual distributions, right? So that's attractive for income investors who want regular payouts. And also it rebalances, the ETF rebalances semi-annually. What that means is basically there is constant regular renewal of the constituents in the ETF or the index. So this ensures that it's not static, because obviously stocks fundamentals and the best stocks, best dividend stocks, or the best quality stocks, they change all the time, they evolve. Even high quality stocks can become rather expensive if the market recognizes them as such. So therefore, the ETF or the index needs to be renewed, and this renewal process is done semi-annually. Just basically going over this, this is the three main factors that come into the construction of this index: business quality, financial quality, so or financial health, and then dividend yield. So what does this do to address the dividend trap? So like I mentioned, right, quite often the dividend trap is because you have weakening business, or there is some problems with underlying problems with, say, the balance sheet. The cash flow is actually not coming in, for example, right? So financial distress could result. So the Morningstar, this index that underlies the Xiang Income ETF, it addresses that by screening for the stocks and ensuring that the 30 stocks in the index do not have high probability of this, right? And how business quality, essentially what it does is it look for stocks with with sustainable competitive advantage. What this means is basically that, Warren Buffett and his moat, right? Economic moat, basically this is essentially what we are trying to create quantitatively through our selection of business quality, right? And what this essentially will result is that the stocks that are inside the ETF, we are reasonably confident that through a market downturn, or whether in an upturn or downturn, the profit margins are relatively defendable. The revenue track record is relatively sustainable, right? So through cycle performance, at least on a fundamental aspect, we are reasonably confident, and therefore you'll be confident to hold it through a cycle. Same thing for the financial health, right? It ensures that the stocks are not likely to go through financial distress, even through a recession. So for example, Paul was saying there is expectations of some recession going forward or inflation, right? You should, I think we would be reasonably confident that through screening this for these quality factors, there should be some confidence and hold conviction through a cycle. Some characteristics of this index. So for example, on the right-hand side, you can see the top 10 holdings, familiar names. So I guess the things that you can see in the STI, for example, the most analogous index probably is the STI index, right? And most familiar with what most people are familiar with. The familiar names are still there, right? So you have all the blue chip names, the three banks, Singtel, SGX, Singapore ST Engineering, Venture, all these are familiar names. One difference, I guess, is the single position limit is controlled to about 10%, right? 30 holdings. So all this we have mentioned. Right now, as of July 2022, so the dividend yield is about 4.0%, right? And based on our screening, we expect that to be relatively sustainable, assuming the prices remain the same. Okay, so the next 2 or 3 I just talk about how is it comparable, because I guess this is a recurring question. Might as well address it here. Many of the underlying blue chip stocks inside the Sing Income ETF are similar to the STI, right? So whether it's the STI index and the Morningstar index, they share quite a number of the similar constituents. But one thing to note, so STI, for example, that you're all familiar with, it screens and it weights the stocks mainly on the basis of size, right, or market value. Whereas the Sing Income ETF, it screens and weights the stocks on the basis not just of size, right? So size is one factor, but at the same time, as I mentioned, there are 2 quality factors and 1 dividend yield factor, right? So that ensures that it's basically designed for the income investor, to put it that way, right? Because it tries to eclectically pick out this kind of stocks that have such characteristics and yet have sustainable income flows. The other thing is that it has single security limit of 10%, right? It may or may not be good. So of course, in market upturns, the banks may do well. Market downturns, the banks may do well, may do badly, depends whether they're bad loans, right? Paul actually mentioned that, he thinks the banks may do well. So if so, then of course, STI may do better because the STI has over about 40% into banks, for example, right? Just the 3 banks alone. Whereas for us, we are less. But we believe in diversification. So therefore, we try to ensure that this is there is no single security over concentration, right? How does it do since launch? So 29 October 2018 was when we launched the Sing Income ETF. And basically what we are trying to show here is the index, the underlying index, which is the Morningstar index, how it compares against the STI index. So this is index versus index, okay? Which the index is more or less reflective of the ETF, because the ETF tracks the index, right? So what you see is more or less similar in performance in general trend, right? Sometimes it does better, sometimes it does worse, right? But if you were to look at it from a longer perspective, well, I mean, I have to qualify that, this is the performance when the actual performance of the index is here, right? From 29 October 2018 when we launched the ETF. But of course, when we crafted the index, our partners Morningstar also backtested the index 10 years, right? Or maybe from 2012 onwards, using the same screening methodology. And based on that, this is how it does, the white line versus the STI. Yeah, sure. Total return, both total return. Yeah, so to emphasize, this is the total return. Total return means including the dividends we invested into the index, right? So it's comparing apple for apple, essentially. Of course, backtested, some people do think, but But basically, the back testing is based on a methodology. So I think this is how it would have looked like if it had started earlier. Okay. So I guess the long and short of it, if you're interested in a dividend-focused kind of product that focuses on Singapore quality blue chip stocks, do consider this. Right. Thank you very much.
Okay. Good evening, everyone. Thank you for joining us today, and thank you to SGX and Phillip Securities for inviting me here tonight. I'm Xiang from lionglobalinvestors, and you can call me the ETF guy of LGI. So I'm here today to share more about the Lion OCBC Securities Singapore Low Carbon ETF. So at its core is a 21st century and green version of the STI. It is Singapore-centric, more well-diversified, and with a stronger focus on a lower carbon footprint. And since the ETF's listing date, if you look here, it has demonstrated similar performance to the two STI ETFs that are listed and outperformed the X-Trackers MSCI Singapore ETF. And if we compare on the index, compare the index on the same period, there's also outperformed MSCI Singapore Index and also maintained comparable performance to the STI. And if we look even longer, compared to the past 10 years, the index has outperformed the STI and MSCI Singapore on a 3-year, 5-year, and 10-year basis. This is based on SGX backtested data. So all these show that you do not have to sacrifice returns, even in a lower carbon portfolio. And besides low carbon, some of you might also ask, why invest in Singapore now? Because we have already seen a lot of volatility that has been happening. But if you look at the next slide here, compared to the broader Asia and ASEAN regions, Singapore has actually done well in the past 5 years. If you look here, and this is because of first a strong Sing dollar, and also while facing global headwinds we see here, in terms of rising inflation and rising interest rates. I mean, we have already seen the US hiking interest rates 4 times this year. First 25 bips in March, 50 bips in May, 75 bips in June, and 75 bips in July. And based on the latest Federal Reserve meeting minutes, and like what Paul already pointed out earlier, there's further interest rate hikes expected, at least until 3.5% by the end of the year. And usually higher interest rates triggers greater volatility in the market. But this brings us also to the next slide about, with higher volatility, Singapore's position as a AAA rated safe haven will especially stand out. And this is in fact reaffirmed by Fitch Ratings rating of our Singapore sovereign rating as AAA, with a stable outlook in late July this year. And while facing all these global headwinds we see in terms of rising inflation or rising interest rates, PM Lee also pointed out in his National Day rally speech that Singapore is still expected to reach around 3 to 4% GDP growth this year. So given all this volatility we are seeing today and also we have been seeing in the past few months, the key to riding out the ongoing volatility actually is to add a stable and efficient and resilient building block within your portfolio. And this building block should also be green because climate risk and ESG are here to stay. Change and ESG risks are here to stay, because Southeast Asia's decarbonization efforts are still falling short. So to limit global warming to 1.5 degrees by 2030, Southeast Asia still has to reduce 3 gigatons of carbon emissions by 2030. So this translates to taking out and taking away 647 million cars off the road for 1 year. And climate change is important because it affects everyone. And many of us do not fully appreciate how climate change affects and is an investment and financial risk within our portfolios. Because in fact, there are 2 types of climate change we want to highlight. The first type is physical risk, because physical risk is about where climate change triggers increase in natural disasters and more extreme weather patterns. And through these, we have seen greater loss of lives and greater loss of wealth. The second type is harder to, and this is mainly on transition risk, which is brought about mainly by policymakers. So for example, the Singapore government this year recently announced additional carbon tax to encourage businesses to reduce their carbon footprint. So for companies that are unable or unwilling to reduce their carbon footprint, they may face the consequence of a lower share price or lower access to funding. So as investors, we need to be aware about the investment risk and financial risk created by climate change and actively protect our portfolio against this. And this is so important. I mean, climate change has been so important that Senior Minister Teo Chee Hean in the Eco Prosperity Week in June this year specifically mentioned that businesses need to incorporate decarbonization and climate risk into their business strategies, or risk being written off. So this is an important and powerful statement because it has even led, for example, oil giants like Chevron, Shell, and ExxonMobil commit to net zero emissions by 2050. And all these highlight the strategic importance of decarbonization and climate risk to Singapore and the world, because climate change can affect investment returns. And this is why, more than ever, we bring you the Lion OCBC Securities Singapore Low Carbon ETF, so investors like you and me can enjoy a convenient and affordable way to invest in Singapore's upcoming low carbon transition. So this is a strategic collaboration between OCBC Bank and also SGX, where because SGX is the index provider, together with Leng and OCBC Securities involved. And you can invest in the low carbon ETF because it brings you and allows you to invest in the upcoming low carbon transition through three key ways. First, the ETFs tracks the IH OCBC Singapore Low Carbon Select 50 Capped Index. So by tracking this index, you gain exposure to 50 Singapore companies that are each committed to a lower carbon footprint. Second, this is Singapore's first low carbon ETF that will pay semi-annual distributions. And third, there's a 7% and 10% securities weightage cap. So you enjoy diversification across stocks and sectors while decarbonizing your portfolio. And this is possible because the index is specifically constructed and designed to minimize the portfolio's weighted average carbon intensity, which basically means, first, it is pronounced as WACI in short, and second, it basically means the tons of CO2 emissions per $1 million of revenue. And as you notice here, the index has the lowest WACI compared to the MSCI Singapore and also the STI. And since its listing date this year, the ETF has closely tracked the index despite the market volatility we have seen so far. And once again, the ETF has maintained comparable performance to the STI ETFs and outperformed the X-Tracker's MSCI Singapore ETF. They are comparable because they are all broad-based Singapore market ETFs. And similarly, on the index basis, where we compare across the same period, the index has outperformed MSCI Singapore and also maintained comparable performance to the STI. And if we look in terms of breakdown by country of listing, you can see here that, for example, the STI is 100% focused on Singapore-listed companies. But for index here, you can see greater diversification because there are Singapore components, US-listed components, and also Hong Kong-listed components. In terms of sector breakdown and sector analysis, you can see that in terms of the sector distribution, it is also more diversified compared to STI, which is first more heavily weighted on banks, and also compared to STI, also compared to MSCI Singapore, where the art weightage, for example, in terms of consumer discretionary is also higher. And here are also the top 20 constituents you can see here. And for example, if we dive even deeper, in terms of the top 10 of STI and also the top 10 of MSCI Singapore, they right now roughly account for more than 70% of the index. But if you look in terms of this index, for the IH OCBC Singapore's Low Carbon Select 50 Capped Index, it roughly accounts for 55%. So this shows greater diversification and clearly shows the benefit of having a weightage cap to ensure diversification across stocks and sectors, to reduce estimated volatility and reduce, not only reduce estimated volatility, and also improve risk-adjusted performance. So by buying this ETF, what you gain is actually a diversified blend of value stocks bundled together while doing good and decarbonizing your portfolio. And when we talk about doing good, I want to share about two Singapore companies that have been doing good, but are under the radar. The first company is CapitaLand Integrated Commercial Trust, basically known as CICT. And the other company is more low profile, it's called Flex Limited. For the first company, which is CICT, it is Singapore's largest commercial REIT. It is also the owner of many properties, for example, like Tampines Mall, Capital Spring, Plaza Sing. And basically, if you see a building that's quite close to an MRT, it's very likely owned by CICT. But what many do not know is actually its active efforts in reducing its carbon footprint. For example, all its properties have a green rating, and it has also committed to net zero emissions by 2050. The other company is Flex Limited, which is the world's third largest electronics design manufacturer in terms of revenue. It is also a giant that has manufacturing operations in more than 40 countries and over 170,000 employees. It is US listed, and it is also a company that has committed to reduce 50% of its Scope 1 and Scope 2 carbon emissions by 2030. Besides doing good, CICT and Flex have also done well financially. For CICT being the largest commercial REIT in Singapore, it is expected to do well with Singapore's reopening and also recovery of its office and retail sector. In Q2 this year, it's also announced the initiative to transform Clarke Quay into a day and night destination by 2023. And also, besides all these, there's also been on an acquisition spree of Sydney office properties. We acquired 2 properties in Sydney earlier this year in March, but also acquired more in June this year. And when compared against the average target price set by analysts, which is set by the market, there's around 20% that's been around 20% upside potential that's been identified. For the next company, which is Flex, is also a company that's done tremendously well. In fiscal year 2022, the top 10 customers accounted for roughly 34% of its net sales, but none of them accounted for more than 10% of its net sales. So this shows actually the diversification of its income stream, because none of the top 10 customers each actually accounted for more than 10% of its net sales. And we compare in terms of the latest quarter, it achieved record high adjusted operating income and EPS. So this is a company that has, in the previous quarter, it also achieved its record high. This quarter, it achieved even better results than the previous quarter. And based on recent results and also recent analyst estimates, there's been also more than 30% upside potential based on average target analyst price. So when we invest, we want to invest in the right companies that grow sustainably. In CICT and also Flex, we see 2 value companies, both high profile and low profile, both locally listed and foreign listed. But by buying this ETF, you gain access to actually many more companies like this, to a diversified blend of value stocks bundled together while doing good and while decarbonizing your portfolio. And you gain 3 key benefits by buying this ETF. First, you will be supporting Singapore in tackling climate change and also supporting Singapore's transition to a low carbon economy. Second, by decarbonizing your portfolio, you also do good for the planet and actively protect your portfolio against climate risks. And third, you get to capture growth opportunities of 50 Singapore companies that are each committed to a lower carbon footprint. So with less than $1, you will be able to participate in Singapore's low carbon transition. So please log on to the Poems platform right now and ask everyone you know to search ESG for the Sing dollar counter and ESU for the US dollar counter to buy this ETF. And if you do not have a Poems account right now, please also open one right now, so we can all make a difference with low carbon. Change starts with you and me. Thank you. Sorry.
Okay. Hi. Good evening, everyone. My name is Bertram. I'm from Nikko Asset Management. The previous speakers has been talking about equity. So from my end, I'm going to talk about Singapore dollar bonds. Some of you would definitely be familiar with the bonds and the bond market. And we in Nikko Asset Management, we manage the two largest ETFs investing in bonds in the Singapore dollar market. So bonds, typically these are your assets that will be a diversification. This can provide diversification because they have lower correlation versus equities, and also bonds have lower volatilities, meaning the movement of performance of bonds are relatively more stable than investing in stocks. So classically, a lot of investors would have an allocation to bonds and equities. So what we're looking at next few slides is talking about the Singapore dollar bonds. What does the Singapore dollar bond market offer to investors like yourself? So what has happened in 2022 is that it's been negative market for bonds, primarily because of interest rates rising. If you're quite familiar with how bond performance moves, it's when interest rate rises, bond performance becomes negative. And when interest rates go down, bond markets perform well. Later on, the historical performance of the SGD bond market will show this kind of dynamic when investing in bonds. This year, interest rates has been rising as the market opens up after the pandemic. Inflation has been quite persistent with supply disruptions exacerbated by the Ukraine-Russia war, with oil prices going above the 120 level. And market has been quite volatile this year for bonds, and it has actually led to interest rates going higher. For example, earlier this year, a 10-year Singapore dollar bond was around 1.6%. So if you buy a 10-year bond earlier in Singapore this year, it's only around 1.6%. But currently, it gives around 2.75%. So that's quite a big jump from what it was previously. And you can see it in across markets, US and Singapore dollar bonds, and even in Europe where bonds are quite low. And in the last few months, more or less, interest rates concern has been, they say, maybe peaking. Markets may have already priced in. The previous speakers are talking about the US Fed hiking interest rates to address inflation. And that may be peaking because concerns of investors are moving from inflation to growth. Some of our speakers have talked about recessionary risk, and recession are good for bonds because when interest rates go down during recession, that's when bonds perform well. And what we think is that the market has already priced in this interest rate hikes, and yields can be consolidating. We've actually seen that since June. In June, for example, Singapore dollar 10-year was around 3.2%. Currently, it has gone down to around 2.75%. So overall, we've seen that repricing by investors from inflation concern to a growth recessionary concern, which is good for bonds from that perspective. So what does the Singapore dollar bond market offer to investors like yourselves? As we've mentioned, Singapore is a AAA market, good regulatory environment, and the investment to bonds typically goes into Singapore government bonds. Some of you may be investing in the Singapore savings bond. The Singapore savings bond is on the lower end of the low risk, and also a good yield because it's a AAA issued by the government, but it's not exposed to interest rate movement in a sense because there's a guarantee in terms of the Singapore government bonds, savings bonds. You're not exposed to movements in interest rates. Whereas if you invest directly in Singapore government bonds, you are exposed to interest rate risk, meaning when interest rates are going up and down, the performance of the bonds will also be going up and down. But from a credit perspective, this is a AAA borrower, and so the probability of default is very low. You're fully guaranteed that your bond will be repaid at maturity. At the next spectrum in terms of risk is the quasi-government bonds. These are your HDB, your LTA, and these are your statutory board bonds, your thematic bonds. And this provide higher yields, but slightly higher credit risk. And at Nikko Asset Management, we've worked with a local regulator, MAS particularly, to develop the corporate bond market. So corporate bonds are bonds issued by corporations, like the stock issuers that you have in the stock market, like DBS, UOB, OCBC, and all the other thematic link companies. They issue bonds in the market actively. And in the past, maybe 10 years ago, there was no index covering the investment grade corporate bond market in Singapore because it was not liquid, it may not be replicable because it was not fully developed yet. So working closely with MAS, we designed in 2018 an investment grade corporate bond that allows retail investor access into this investment grade corporate bond market. Individually on your own, buying a single corporate bond is on the over-the-counter market. The minimum investment is usually $250,000. So buying a single corporate bond in the market will be too expensive. So that's the advantage of the ETF. It provides access to investors like yourselves and access to this asset class that used to be exclusive to perhaps private bank clients. And so an ETF provides access to this investment grade corporate bond market. So in the next few slides, we'll look at where and what do you get when you buy into an ETF, a bond ETF. The first allocation here is the ABF Singapore Bond Index Fund. This is an ETF that we launched in 2005, investing primarily in Singapore government securities, Singapore government bonds primarily. Around 83% of it is Singapore government bonds. And you can see at the bottom, there's a yield indication, which is 2.94%. 2.94%, currently around 3% as of yesterday, indicates the yield that you get from this portfolio of Singapore government bonds. And the other part that you should look at when you invest in bonds is the duration, which for this ETF is 7.7. Duration for an investor is an indication of how much interest rate risk you are taking. It will move much faster in terms of performance if it has high duration. So a simple analogy is that if it's a 7-year duration, if interest rates move up by 1%, the price movement will be negative 7%. But on the reverse, where interest rates are going down, a 7% duration means a 7% return in terms of prices. This is true for a bond index, and it's also true for a single bond. So if you buy a single bond with a high duration, you're more exposed to interest rate risk. The other ETF that we have, as I mentioned, is the investment grade corporate bond ETF. So this invests in non-Singapore government bonds. The biggest chunk comes from the statutory boards. About 20% is HDB. HDB is an active issuer in the Singapore dollar bond market. It provides an additional spread of around 20 to 40 basis points over SGX, meaning when HDB issues a 5-year bond, usually its yield is around 20 to 40 basis points above that of the Singapore government securities. The other active issuers in the Singapore dollar corporate bond market are your banks. DBS, OCBC, UOB are active issuers. There are also foreign banks that issue in this market. So not just Singapore banks issue here. So a lot of European banks has been using the Singapore dollar market to raise funds. The other big chunk of issuers are your thematic link companies. So the likes of Singapore Airlines, Mapletree, these are active issuers in the Singapore dollar bond market. And what you can see here in terms of yield is around 3.8%, meaning you get higher yields investing in these corporate bonds. Currently, the average credit rating is a single A. This ETF is focused on investment grade. We don't buy high yield, so there is a low default risk probability in the bonds that we hold in this index. You might have heard about 5 years ago or 5 to 8 years ago of bonds that have defaulted in Singapore. This index ensures that there is composed of high quality Singapore dollar bond issues. In terms of duration, it's around 6 years. It has relatively lower duration compared to Singapore government bonds, but still, because of the issuance coming from the statutory boards that are of a longer maturity, still the duration can be 6 years. If you really want a short duration strategy, like a 2-year or a 3-year, it would be more the short duration kind of funds. These ETFs relatively have high duration of around 6 to 7 years. So this slide shows the historical yields of the Singapore government bond market. So if you can see here from 2013, the range of yields is around 1% to recently crossing 3%. You might have heard of the 1-year Singapore Treasury bill auction recently. It yielded 3.1%. Recently, some of the Singapore savings bond auction may have yielded around 3.1%, which led to more headline coverage about Singapore government bonds providing attractive yields. Because you can see here in the historical chart since 2013, it's actually quite attractive now. It has risen to around 3%. It was around 3.2% in June, and it has rallied a little bit in the third quarter. So currently, the Singapore dollar bond market provides 2.9%. The chart below shows historical performance. So what I want to highlight is that during the pandemic and in 2019, there was a lot of uncertainty. Interest rates were being cut by central banks, Singapore, MAS included. So there was an aggressive cut of interest rates to support the economy. So when interest rates are being cut, that's when bond performs really well. So you can see here in 2020, the Singapore government bond ETF that we have returned 8.5%. In the same way that when you have a Singapore savings bond that's earning 1%, you may not want to buy. So at the end of 2020, when yields are at a low level of 1%, interest rates started to move up. Economic reopening, inflation started to rise. And so when inflation is rising, when interest rates are being taken higher by central banks, that's when bonds unfortunately perform negatively. So in 2021 and this year so far, the bonds have returned negatively because of that duration risk that we have for this ETF, that when interest rates are moving higher, that's when bonds unfortunately does not perform well. And it's the same on average. If you look at the average of this since 2013, the average return of this government bond exposure is around 1.2% per annum. So on an average, if you just hold this ETF regularly and steadily, it returned 1.2% decently in the last 9 to 10 years. On the other hand, the Singapore corporate investment grade market, this is a new market that has been just developing in the last 10 years. So the ability for us to invest in this market is a good potential for investor to allocate into higher yielding bond instruments, higher than the yields that you get from Singapore government securities. So if you look here, currently it's yielding around 3.8%. On average, since 2013, it's around 3 to 3.5%. And so that's quite a big pickup of around 100 to 150 basis points compared to just investing in Singapore securities or even investing in Singapore savings bonds. And you can see here, since 2013, it did have steady positive returns between 1% to 6%, but the sharp movement in interest rate risks has reduced the performance negatively, particularly particularly this year when interest rates was moving quite sharply from around, if you look at here, from around 2.5% at the start of the year, currently 3.8%. That's around 130 basis points of interest rate movement within 8 months, and that has led to around 6% negative return year to date. But having said that, if you break it down between the first half and so far in the third quarter, the fact that yields have gone to an attractive level of around close to 4% in the third quarter was actually quite positive when rates started to slowly go down, and that has led to around positive returns in the third quarter. I think what's good with the level of interest rates now at 3.8%, one is that you do get as this level of coupons, this level of interest income. The thing is, in case that there is a recession that can happen with the recessionary risk coming in, there's more interest rate buffer that you have with 3.8%. And if interest rates go down, there's a price capital returns that you can get. So in the same way in 2020, when the interest rates were being cut because there's economic weakness concern, that's the same when there's recessionary risk that's being priced in by the market, perhaps next year, and that can be positive for the bond market. So this is a good investment opportunity for investors who look at, on a medium-term basis, a 3.8% level of interest rate hasn't happened for quite a while in the last 10 years. The last time you had around 3.8% for this market was around 2014. In 2021, it was as low 2%. So on average, from 2013, earlier I mentioned Singapore government ETF yielded around 1.2% per year. This index returned around 2.5% per annum. So that's around 1.3% higher on a year-on-year basis. So annually, there was more than 1% better average return investing in corporate bonds versus that investing in Singapore government bonds. The thing with Singapore government bonds is that the only thing that I would like it for me personally as an investor is that when there's recession, when there's flight to quality, it is a safe haven asset class. It's when government bonds perform well. That's why in 2020, Singapore government bonds gave you 8.5%, while the corporate bond only gave you 6%. So government bonds perform well in a recessionary environment when interest rates are being cut and when there's an economic outlook concern or recession concern. And what we're talking about in terms of corporate bonds, why do they perform better in the long run, is because of the credit spread, they call it. When you lend to a corporation, you will definitely ask for higher yields compared to a higher quality borrower. So Singapore government bonds, you will pay them, they will pay you lower interest rates because they're a high quality borrower. It's a AAA borrower. But for corporates in Singapore, on average, it's an A credit rating average. The average credit rating is around 100 basis points. Currently, it's around 110 basis points. So going forward, we expect that this is more or less a stable kind of credit spread provided by investment grade corporate bonds. And the only time that you can see here that it spiked up higher, when credit spreads also spike higher, returns can also be negatively impacted. So this is during the COVID peak in 2020 in the first quarter and second quarter when credit spreads doubled quite significantly from around 100 basis points to 200 basis points. At that point in time, 200 basis points is actually a good time to invest, but that was in hindsight, assuming that the pandemic will be managed and the economy recover. And so it took us around 1 to 2 years to bring back the credit spread to where it was the pre-pandemic levels. So in summary, what we want to highlight, we provide the two bond ETFs in Singapore. One invests in government bonds, the other one invests in corporate bonds, investment grade. We don't hold high yield. Government bonds perform best when there's a risk-off market environment, but it is weakest when interest rates are rising and during economic recovery and when inflation is high. And that's how the government bonds returned negatively this year. On the other hand, corporate bonds, particularly investment grade quality, they provide additional relatively stable credit spreads to offset the impact of rising interest rates. But it's still impacted by interest rate movements, of course. And lastly, that interest rates have significantly adjusted from their low levels. On a historical basis, it's now relatively attractive. That's why Singapore savings bonds are quite attractive to investors right now, because seeing around 2.8 to 3% is quite attractive. In the same rationale, investing in Singapore corporate bonds is also quite attractive at this time because of attractive yields that they are providing. And using bond ETFs is an easier way to go into it, because investing individually, buying individual corporate bonds, let's say buying a DBS bond, 250,000, and buying an ETF will just need $1,000, $10,000, and you can gain exposure to the whole market, which is diversified. On another hand, Singapore savings bond, your allocation might be limited. You can only get, because you might only get 9,000, but you have 50,000. You might need to invest in the market now, and so a bond ETF is the next alternative to a Singapore savings bond. Thank you so much. Yeah.
So now we'll move on to the next section of today's presentation. So may I invite our distinguished speakers to be on stage. So we are entering into our Q&A and panel discussion sessions. What you are seeing on the screen now and in front of your laptop is, maybe Bertram, I could take this seat. In front of your laptop, there's a pigeonhole. Probably there's a QR code or a link that you could click on. While we get started on this section, feel free to enter more questions, and we are seeing more coming in. So do let us know if you have any questions following the four exciting presentation from our speakers. So maybe I'll just start off with a couple of those that I am seeing. In fact, some of them we have received it earlier on as well. So I think one of it is associated with the existing investment climate landscape. So I think most of us who have read the news, MAS has been going on monetary tightening measures. Rates are rising, as per what Bertram has just shared earlier on. And there was some insightful thoughts about the impact on government bonds, along as corporate bonds. So I think one of the questions that the audience has asked is whether at this current climate, is it still a good time to enter into Singapore stocks and bonds? Probably your view as well on how do you think the market will perform in the short to long term. Perhaps we could start with Xiang on your view towards Singapore market at this point.
Okay, thank you, Wei-Chin. this is a good question. It's relevant, especially in this climate we see now. So what all my co-speakers have already mentioned, we are living in a world of increasing inflation and increasing interest rates. US Federal Reserve has hiked interest rates 4 times this year. And like what Paul mentioned, is expected to hike at least 1%. Hello? And it's expected to, is it better? And it's expected to hike interest rates at least to 3.5%. It's okay. To hike interest rates to 3.5% this year. And higher interest rates usually triggers a lot of market volatility, which we are seeing here. So, and if we talk about inflation, I would say there are 3 key types of inflation we need to know. The first is, I can summarize them into, there's tests. Is it better? Can the back hear me? Okay, there are 3 types of inflation we need to take note of. Basically, I can summarize them into 3 letters, CCA. So the first type is consumer inflation, which is about the rising prices of a basket of consumer goods and services. The second type is commodity inflation, which is about rising commodity prices. And this is expected to, for example, benefit many of ETF constituents because, for example, like capital and also like venture corp, they have really committed to a lower carbon footprint. So it's like rising commodity prices are actually expected to benefit these type of stocks and sectors. And third is about asset inflation, which is about rising valuations of assets, for example, like within the banking sector or real estate sector, which also happen to be part of the ETF, where there are also banking and also real estate constituents. And we look at the broader picture, like what Wei Chin really pointed out. I mean, we have seen MAS tightening monetary policy and appreciating the Sing dollar. And Singapore also tends to respond well to to commodity inflation and also to asset inflation. So in terms of the outlook for Singapore, I would say due to Singapore's policy in tightening and also appreciating the Sing dollar, and so its previous history in responding well to commodity and asset inflation, I mean, outlook for Singapore will be positive. But we also shouldn't forget that while the outlook is positive, climate risk and also ESG are here to stay. So when you construct a portfolio, it's important to have both a resilient building block and also a green building block within your portfolio, like the Singapore Low Carbon ETF.
I'm working, my mic is working. So I think from my end is that it's all about, is inflation peaking? Are we confident that the central banks, with the interest rate hikes that they have done aggressively, the US Fed has already hiked 225 basis points, the MAS has already did 4 actions since October last year. They did 2 off-cycle changes on the monetary policy. And do we believe that inflation is already at its peak? Perhaps it has. The government has already indicated that it will still stay elevated for this few months, but it may be peaking towards the end of the year. So from that perspective, given where yields level are, and a lot of investors in a way are quite opportunistic. When they think that inflation is already peaking, then they will start to buy and invest quickly. We saw that in June when US 10-year was around 3.47%, when there was a shift in concern with regards to maybe inflation is peaking and we should look at recessionary risk. That's when yields started to go down and bond investors started to buy into bonds as well. And so I think, as I mentioned in my previous presentation, that yields are at an attractive level. If you view and think that inflation is peaking, then I think it's a good time. And on a medium to long-term perspective, it's actually quite an attractive yield to get into bonds now.
Yeah. Maybe just one question to add on to that. We know that T-bill is now close to 3% as of the latest auction, and even the one that retail investors getting to be more involved in the Singapore Savings Bond as well, SSB, which probably is getting close to 3% as well on a 10-year yield. So any views towards that when you compare to a short-term instruments like T-bill against a longer-term duration bond ETF, probably like the corporate bond or the ABF bond ETF? What would the typical approach investors should be when viewing these 2 instruments?
Yeah. Taking an opportunity on let's say, for example, the 1-year or the 6-month bills, it's good. You get 3%, but it's only good for 6 months. It's only good for 1 year. On the other hand, you have reinvestment risk in those kinds of instruments. The other side is if you buy Singapore savings bonds, of course, that's a nice investment if you can get an allocation. So there's strong demand, but there's limited size that can be allocated. If you have, I think per investor, there's a limit of 200,000 K. And so if you have an allocation and if there's strong demand, some investor may only get 20,000 or only 10,000. So the next alternative to getting exposure to Singapore be a bond ETF or buying directly a 5-year bond on your own or using a bond ETF. But the thing I like about bond ETFs is that in a recessionary environment, it performs and gives you the diversification benefit of what bonds should do. They perform well during recession, and which the Singapore government or savings bond will not provide you. You're just fixed at 3%. On a risk-off environment, as I mentioned, during the pandemic, Singapore government bonds, ETF, gave you 8.5%, whereas at that time, a Singapore savings bond may only be yielding 1%.
True, and exactly, and as if interest rate starts to reverse,
Correct.
starts to drop, then probably having a bond in a portfolio will have capital returns.
Correct.
On top of the regular dividends.
Yeah.
And maybe for Teck Leng as well, because we do know that Phillip has a Singapore money market ETFs. So any view on this particular instrument at this current environment?
Yeah, well, that's, can you hear me?
Yes.
Yeah. So, yeah, that's another of our ETFs, which I didn't cover here, but essentially it invests into short duration or short-term money market instruments and fixed deposits. So essentially what it does is the unit holders' money is invested into fixed deposits. We can get better rates because it's done at institutional level. And we also put it into short-term money market papers or corporate bonds. Yeah, it definitely benefits from rising interest rates because when, for example, right now we can get better fixed deposit rates, for example, right? Close to 3%, for example, for short-term fixed deposits, and similarly, short-term money market papers. So as and when it matures, then we can roll over it into the current interest, higher interest rates papers or fixed deposit rates. So we actually see it as a good way to manage your cash. Yeah.
Thanks a lot, Teck Leng. Another question, probably I'll move on to the next question as well. There's a question that asks whether investors should focus more towards growth or value stocks in today's investment climate. So I think in today's sharing session, we have seen one from Leng Global, Low Carbon Etf, and as well as Phillip Sing Income. So I think for Phillip Sing Income is a bit tilted towards dividend paying.
But to ask me, it is not really characterizable into either value stocks or growth stocks focused. Rather, I would characterize it as quality stocks focused. So quality can be quality growth or quality value, right? What basically it means is that these are the companies that have defensible economic modes or business modes and very safe in terms of their financials. And therefore, you should be confident in, or you should be able to have conviction in holding such a portfolio of quality stocks through cycle. Through cycle, what that means is through a bull market, of course you benefit, but even through a bear market, you should be able to be comfortable, sleep well at night, right? Because these are the stocks that are able to defend, or at least we believe, based on their construction, they're able to defend their margins in an inflationary environment, for example. So, expanding more about this theme. So I guess in a rising interest rate environment, you have seen that the growth stocks over the last decade that have gone up so much, they start from a high base. That's one reason why they've corrected so much. But at the same time, also the low interest rate environment has fueled their rise. Because they have had easy money to fuel their growth, right? Even subsidizing, I mean, some of them might even be, they don't mind spending enormous amounts of money or subsidies to fuel revenue growth. But all that breaks apart in a rising rate environment, like right now. And that's why you are seeing, at least in the early part of this year, the growth stocks have massively underperformed. But I guess at some point there will be some differentiation. People will be sifting the wheat from the chaff for growth stocks themselves. For example, let's not look at Singapore. Let's say, for example, in the US, you have seen stocks like Apple. They have rebounded strongly from the base, even though it's typically people see as a growth stock, right? The Fang and so on. other growth stocks have continued to falter over the past few months. So I think this is a phase where it's not just a matter of characterizing growth or value anymore at the current phase, but it's also about people recognizing that certain growth stocks are better than others or certain value stocks are better than others. Right? That's my view. Thank you.
Thanks, Teck Leng. Maybe for Paul, there's another question that is associated to bank and REITs. So this, apart from value and growth, I think investors are also keen to know how might bank stocks or REITs be performing under this environment, which obviously STI has a huge exposure towards that. Do you have any view towards these two particular sectors?
Obviously, banks should clearly benefit. I guess the overhang now is just whether are we in a provisioning cycle. That means the bad debt provision, but we think it's unlikely because we are exposed to Malaysia, we are exposed to Thailand, Hong Kong, and you don't see a cycle there. For REITs, the problem for REITs right now is that with the rising interest rates, I mean, we do some back of the envelope calculation, they need to grow maybe 6 to 7% MPI yield just to stand still, just to maintain dividends. They need to get that growth. So if you buy any REIT that doesn't have a clear growth trajectory, you bought a bond. Sadly to say, it's just a REIT wrapped up like a bond. So REITs have to be. That's why we only favor REITs where there's a clear growth trajectory. Although they will all say that they are hedged. You know, SIA also hedge their fuel, right? But it doesn't last forever. So this will be a bit more wary when it comes to REITs.
Thanks a lot, Paul. Maybe bringing back the focus to some sharing from Xiang earlier on regarding the low carbon SG ETFs. Why should investors focus, in fact, on climate risk? And what do you think are the possible ways for them to mitigate such risks from their investment portfolio?
Thank you, Richin, for the question. So to bring back to the bigger or broader picture, climate risk is both an investment risk and financial risk. I mean, that's the physical risk we see because there's greater natural disasters, more extreme weather patterns that triggers loss of lives and loss of wealth. There's also the transition risk we talked about earlier. For example, when the Singapore government, when they announced additional carbon tax to encourage businesses to adopt lower carbon footprint, those who are unwilling or unable to do so might face consequence of lower share price or lower access to funding. So this is an important investment risk and financial risk created by climate change. And during the Eco Prosperity Week in June this year, Senior Minister Teo Chee Hean also already highlighted that businesses need to incorporate decarbonization and climate risk into their business strategies or risk being written off. So at least first establish the case and the strategic importance of climate change for Singapore and the world, because climate change can affect investment returns. And for the next question about potential methods to invest or hedge away climate risk, there are two key methods. First is investing in green solutions. So this will involve, like, for example, investing, having a more, I would say, is rather a specific and targeted approach. So usually this kind, it would be more of a more narrow investment focus. For example, like investing in clean energy company specifically, or for example, or practicing impact investing. So for institutional investors, this is usually, I would say, a satellite allocation, which is pursued more on an opportunistic basis. Whenever, for example, a specific opportunity arise, maybe I allocate X%, small X%, because these are more specific kind of opportunities. The other way is through decarbonizing your portfolio, which is usually a more core allocation. Usually I would say a greater allocation, because these type involve more broad-based exposure. So when you decarbonize your portfolio, you actually reduce the overall carbon footprint of your portfolio through broad-based market exposure. So this is also how most institutional investors usually what they do. So in short, what they usually do is decarbonize their core portfolio. and also allocate on an opportunistic basis to green solutions. And by investing through a low carbon ETF, this is how investors like you and me gain a convenient and affordable way to invest in the upcoming low carbon transition. And this is also how we provide access to 50 Singapore companies that are each committed to a lower carbon footprint. Thanks.
Thanks a lot, Xiang. One more question is regarding, or rather it's a very common question that we always hear from investors in terms of the way they should manage their portfolio, assuming they are using ETFs to build their portfolio or even to invest over a regular period. Would a DCA, dollar cost averaging, be a better way for them to do it? Or should they be doing a lump sum investing? I think especially at this current climate landscape, where there's some uncertainty on the inflationary environment and also interest rates hike. So is there any probably word of advice from your side or recommend or thoughts regarding the approach towards lump sum or regular savings? Maybe you should start off first.
Thanks, Wei Chin, for the question. So, regarding this question, I think the most important point to highlight is, first, we need to have the money to invest first. So and in terms of whether lump sum or RSP, usually this is more on personal preference. Usually if the investor is more active and prefers monitoring the market more frequently, lump sum usually could be a better approach. On the flip side, if the investor is actually more passive and monitors the market less frequently, like portfolio managers you see here, maybe dollar cost averaging would be a better approach. But regardless of the approach adopted, right, the key is actually having the discipline to stick to it, and also at the same time take into account that it is important that portfolios are made up of building blocks. So while you build your portfolio, it's important that you cover different aspects of your portfolio, and one of the building blocks should also be green, like including the Singapore Low Carbon ETF. Thank you.
From my end, in a way, my understanding is if you have an asset allocation already in place, then you would invest in it. And if it's already existing in your portfolio, then every time you have new money coming in, then you just invest in the market based on that asset allocation that you have decided on. And whether it's lump sum or RSP, a regular savings plan, my idea is that it's because you have regular income coming in on a monthly basis. So you have a regular savings plan coming in because you allocate every month into that asset allocation, maybe 50% bonds, 50% equities. And for me, it's about maintaining the discipline of your asset allocation. It would be whether it's for a 5-year investment horizon or your retirement allocation. So I think for me, it more depends on your asset allocation and where your portfolio is now. If your asset allocation is 50-50 bonds, but currently it's actually 80% equities, then definitely you should lump sum reduce it immediately, because that's not what's supposed to be your allocation is.
So in short, have a good plan, have a plan in terms of your asset allocation and stick to it.
Correct.
Be it doing a lump sum or be it doing RSP, or rather regular savings, which I think a lot of providers in Singapore, including Phillip Securities, which through the Share Builders Plan, do allow investors to start and automate their regular savings behavior. So I think there are also quite a long list of products that are made available on their platform. So probably that's something that if the audience who are physically present today could always find out more from the Phillip Securities who is stationed outside. So maybe one last question, but if there's any question from the ground, feel free to raise your hands. Junjie is over there, and he could always pass you the mic so that you could ask the question live. So maybe just one last question that is coming from the Pigeonhole. Probably it's a simple one. What is the distribution policy for ETFs? Probably this relates to how an ETF typically pay out dividends And if I'm not wrong, most of the ETF that were shared today do pay out regular dividends, a bit different kind of frequency. Some ETF do pay out once every year. Some do pay out probably once every quarter or once every 6 months. Is there any sharing you'd like to elaborate more in terms of what should investors look out for when they are comparing perhaps dividend yield of ETFs? Should there be more focus towards the yield that is paying, or in terms of, or what other areas they should also place focus on? Maybe Teck Leng, you'd like to take this question?
Yeah, so for the Sing Income ETF, well, obviously the distributions would be largely funded from the dividends that it receives from the underlying constituents of the ETF. Yeah, so that would be the main source of the distributions that are paid. But I guess also generally, right, if you were to if you wanted to look at the dividend qualities of that ETF, you may not just want to look at how much distribution that ETF pays, but look through to the underlying constituents of the ETF. Because sometimes the ETF may not be paying the full amount of the income that it receives, but nonetheless, it may still be attractive in terms of the underlying constituents. So, for example, right, let's say the underlying constituents, the weighted average dividend yield may be like 5%, but the ETF, for some reason or other, it decides to pay out maybe like just a 4% or 3% dividend yield. But nonetheless, the underlying constituents weighted average dividend yield of 5% is definitely attractive. So, try to look out for that number as well. That's worth noting. Yeah, so that's what I have to contribute.
For bond ETFs, the way we structure our dividend or distribution policy is almost aligned with how an individual bond, a single bond, pays out coupons. So we pay semi-annual dividends twice a year, and it's usually based also on the coupon income that we receive from the bond. So it's almost like the coupon income that we receive, that's the part that we distribute to investors. So in the end, what remains in the ETF is the capital price movement.
So assuming there are 100 over corporate bonds, right? The investors don't have to collect 100 times a year, right? You will streamline it into 1, 2, or 4 times, probably, and pay them out on a regular basis.
Yeah, we do it twice a year, every January.
So they almost behave like a bond with 6 monthly coupon payment, but then the stream is coming from a few hundred, probably 100 plus issuers.
Yes, we consolidate it and pay it out to the investors.
Xiang, any points to add on?
Yeah, I mean, definitely the points to add on, like what Teck Leng mentioned. I mean, the key is also, I mean, not just on the dividend figure itself. It's about quality constituents inside, and also about in terms of the macroeconomic theme, where it sits in, whether it fits the current theme. So right now for Singapore, the theme I would say is safe haven and stability in this period. So high income certainty, I understand, would be important. And also, if we look even longer term, staying green is also important thing. So because decarbonization is what the Singapore government wants to push for, and it's important. For the Singapore low carbon itself, the distribution policy is semi-annual, and the first distribution is expected in December this year. So in short, for Singapore low carbon ETF, things to take note of for distribution policy will be semi-annual, and first distribution expected in December this year. Thank you.
Thank you, Xiang. There are just last few questions which I thought is pretty straightforward, so I'll just take them. One of them was whether you could use SRS or CPF to purchase the ETF units. Straightforward answers is SRS, yes. All SGX listed ETFs are available via SRS. CPFIS, it depends whether it has already been included. So on the CPF website, you could download the list of approved CPF IA, CPF OA investment scheme approved list of ETFs. Next question would be on what currencies can I trade in? So we allow dual currency trading. So i.e. You can, for example, most of the ETFs listed on SGX, including what Xiang has shared, I think he mentioned the stock code as well, ESG. So there's a dollar version to it as well, ESD. So likewise to some other ETFs that Nikko AM and Phillip Capital Management managers, they do have dual currency trading options. Last but not least, there's one more question on what's the typical expense ratio on SGX. You could find out this information on the fact sheets that the issuer will provide for each of the products. Likewise, on our SGX website, there's an ETF screener. So you just go to search for SGX ETF screener, and you should be landed on a page where you can see the list of total expense ratio that's applicable to each of the ETFs. And one more is, how do I buy the ETFs? There are a few ways. I think we spoke about RSP, regular savings plan. Certainly, you can also trade through any of your broker. Just to highlight, I think earlier session you saw the existing campaign that Phillip Securities is running. So that was something that's ongoing to commemorate the 57th National Day that we have just celebrated. So if you need to find out more about how do you get yourself enabled, feel free to, and certainly we can share a few more information on that. So I think we have reached the end of today's session. So probably let's give our distinguished speakers a round of applause. Thank you.